Hey guys, it's Nick. In this video, I want to talk about what happened on Friday with Archegos Capital, their margin calls, the liquidation, the big block trades, and all these Chinese tech names, along with Viacom and Discovery and all that kind of stuff. Now, it's Sunday night around 12:30, and there are still things going on with that situation right now, with Nomura Securities, with Morgan Stanley. So I'm going to talk about that. And I'm going to talk about what that could mean for stocks tomorrow, the stock market, and those stocks in particular. Do they have a possibility for a bounce? And I'm also going to talk about a lot of lessons you can learn from what's going on here. They apply to investing in all manners of investing. So there's a lot of lessons to be learned here if you don't already know these lessons. So this article on Reuters say large block trades that cause selling raises questions about the cause. Big blocks traded in Viacom and Discovery, and they tumbled around 27% each, along with BIDU and Tencent, dropping as much as 33 and 48% from Tuesday's closing level. Since then, it's come out that these trades were liquidations, margin calls for Archegos Capital Management, which is a family office of Bill Hwang. Goldman and Morgan Stanley sold like $20 billion worth of stock. Morgan Stanley sold about $13 billion, including Fartech, Discovery, BIDU, GSX. And Goldman sold about $6.6 billion of BIDU, Tencent, and VipShop. And then that move was followed by $3.9 billion of Viacom and IQE. So a whole lot of selling in a short period of time. These stocks have fallen a whole bunch. So what is Archegos Capital Management and who is Bill Hwang? Archegos is a family office. Bill Hwang is actually a tiger cub. And if you don't know what a tiger cub is, it is basically a student of Julian Robertson, who opened one of the first hedge funds like in 1980. And closed it around 2000, and all the people that have worked for him have gone on to start their own hedge funds, something like a total of maybe like 50 people. And so those people are referred to as tiger cubs. Bill Hwang founded and ran Tiger Asian Management from 2001 to 2012. What it doesn't say here in this bio, though, is that he pleaded guilty in 2012 to wire fraud and trading non-public info, which is basically insider trading, and apparently gained like $16 million from it in 2008, 2009, paid a fine, I think like $44 million. Okay, so that's who Bill Hwang is. So how did Bill Hwang have $20 billion and more to buy all these stocks? That's what's going on here. He didn't. He was using a lot of leverage. Here this article says these brokerages fueled a pipeline of billions of dollars in credit for Hwang to make highly leveraged bets on stocks such as Chinese tech giant BIDU and media conglomerate Viacom. So they're saying now Hwang is at the center of one of the greatest margin calls of all time. His giant portfolio in a messy and painful liquidation, and Goldman's reversal has thrust it right into the main. Okay, so he got a margin call and they liquidated some stocks. Is the worst over now? Not exactly, because tonight this news comes out that Japan's Nomura, which is a large brokerage company in Japan, says it lost $2 billion at U.S. unit and it had to cancel a bond issue. Now, it doesn't say in the article that this is because of this margin call from Bill Hwang, but that would be quite a coincidence if it wasn't directly related to this. And so Nomura is down something like 15% or so from its close on Friday, right now in Monday's session. Now, in this Zero Hedge article, they say Nomura back in 2016 announced it suffered its biggest loss ever, which was only $40 million from a single client, which it quickly blamed on incompetent bond trader. Well, if 40 million is incompetent bond trader, what is a $2 billion loss? Now it says it's not immediately clear how that's linked to this margin call, but it says here Wall Street Cynic, the brokers became involuntary principals here as they own shares in the outstanding on leverage swaps to their clients. If the client can't meet the margin calls, the brokers take a huge loss. For example, Nomura owns 10 million shares of GSX as of 12/31/20. So is that part of it? Possibly. But wait, there's more. Even though Viacom has taken a beating and dropped over 50% in just like 4 or 5 sessions. Apparently, as of Sunday night, the seller was not done, as Bloomberg headline confirms. Viacom holder said to offer 45 million block via Morgan Stanley. Here's where it gets really funny. Just last Monday, Viacom sold $3 billion in common and preferred stock, including 20 million shares of Viacom at $85. The stock traded as low as like $40 on Friday. So why don't they do a 20 million share buyback for half the price that they got when they sold it a week ago? And Tencent is actually doing just that, and they announced a 1 billion share buyback to offset just this liquidation-driven drop in stock price. So Tencent announces 1 billion share buyback. So what can we learn from what's going on here? Well, number one is that leverage kills. And the poster boy for leverage is Long-Term Capital Management, which was a hedge fund run by Nobel Prize winners in economic sciences, that they made the Black-Scholes model for options and all this stuff, and they were geniuses. And they had a way to make almost risk-free money, supposedly, trading bonds, but they needed a whole bunch of leverage, and they leveraged up $5 billion to $125 billion or so. So that's, 25 to 1 leverage. And so a 4% loss in your position wipes you out and wipes out whoever's lending you money. Now, I don't know how much leverage Bill Hwang was using, but it must have been a good amount. And just a look at the Chinese tech stock index has been taking a big hit in the last few days, along with Viacom. So if you are highly leveraged in those positions, just a small amount of a move will really hurt you and probably cause you to be liquidated. And not to mention, once other people on Wall Street get a whiff of what's happening to you, they turn the screws and start shorting these companies even more to cause maximum pain, because if this guy has to get liquidated, they liquidate at any price. So it goes down really fast, really quickly. So that leads to lesson number 2, which is don't bet the farm, or 5 farms for that matter. So it's a little take on leverage kills. Don't put all your money in any one stock, and definitely if you have $100, don't bet $500 on something, because a small amount will take you out. So look at Viacom. I mean, this thing is up a lot. Just in 2021, from 35, it's up to 100. And from that, 1, 2, 3, 4 trading days, it went from 100 to 40. So if you're betting the farm saying, I love Viacom, it's going to do great and this and that, maybe. But if this happens to you, you just wiped out half of your money, and you need to double your money to get back to where you were. So never bet the farm on any one stock or idea. And for those lucky people that invested in these Viacom preferred stock at $100 just a few days ago and watch it go to $60 in 3 trading sessions, that's another reason never to bet the farm on any one stock. Another lesson to learn is that stocks take the escalator up and the elevator down. And in this case, Discovery, they didn't even take the elevator down. It looks like they jumped out the window to go down. So it can happen anytime at any stock. So don't fall in love with the stock, and don't bet the farm for sure. Another lesson to learn is that Goldman is always in the center of what's going on. No matter whether it's good or bad, you're going to find Goldman Sachs there somehow. So this article talks about Goldman's U-turn on lending money to Bill Hwang for for his leveraged stocks. See, because Bill Hwang pleaded guilty to insider trading and was deemed such a risk by Goldman Sachs that as recently as 2018, the firm refused to do business with him. Those misgivings didn't last very long because this guy was making tens of millions of dollars a year in commissions to rival dealers. And so Goldman removed his name from its blacklist and allowed him to become a major client just in time. So traders familiar with Hwang's orders describe Hwang as running a long-short strategy with exceptionally large leverage, meaning that for every dollar of his own, he'd pile on several times as much in borrowed money. So I don't know what several means, but I got to think it's more than two. So maybe 3, 4, 5 times if he can get that much credit from Goldman and Credit Suisse and Morgan Stanley. Another lesson you can learn from this is that analysts on Wall Street are just cheerleaders. I've said this before and I'll say it again, and they are like the proverbial closing the barn door after all the horses have gone. So look at this, March 26, Wells Fargo downgrade from equal weight to underweight. Moffett-Nathanson 325 downgrade neutral to sell. 326 is Friday, 325 is Thursday. The stock was $100, on Monday or whatever. So they wait until the stock gets chopped 40, 50% until they downgrade it. Thanks a lot. That's why you should never listen to what analysts say or their downgrades or upgrades or whatever. They're usually way late. And the last lesson you can learn from this is that history doesn't repeat, but it sure does rhyme. So I don't know if you remember this, but after the 9/11 attacks, Disney sold off like crazy, and the Bass family, the Texas oil company family that were billionaires from oil and all of that, they had a huge stake in Disney stock back from like the 1980s. They were forced to liquidate 135 million shares in Disney stock because of margin calls. And so, like I said, Goldman Sachs is always involved in everything. Here, Goldman Sachs arranged a block trade, one of the largest ever. Disney bought 50 million of those shares from the Bass people, and the remaining 85 million were sold to institutional clients, according to Goldman. Funny thing is, Disney executives may have known the sale was coming. On Monday, the company raised $1 billion through the sale of corporate bonds in the first debt issue by a public company after the 9/11 attack. Goldman Sachs bought the entire issue. What a coincidence. And is it a coincidence that Viacom just did that $3 billion secondary and preferred offering just a few days before the stock tanked 50%? And is it going to be a coincidence if they all of a sudden come out and say that they're going to do a big stock buyback of those shares that they just sold a few days ago? So let's take a look at that Disney block trade of 135 million shares and see what we can learn from that. So here is September 10th. The market was closed after September 11th for a few days. It opened, it started going down, and Disney was hit pretty hard because of, people are afraid to travel and all. Same kind of thing, kind of like now with coronavirus or whatever. And so this is where they liquidated here. And it says they liquidated at like $15 a share. So the low here was $15.29.5. And you see that after this huge volume and this big spike, and this candlestick basically says the day started off here, went as high as here, went as low as here, and ended up here. And the next day was actually positive. So after really large block trades like that, when the sellers are done, the buyers usually come back in if they know that there's nothing structurally wrong with the company, there's no fraud or something like that, it's just somebody got liquidated. A lot of times, this could be a very good buy. And you see, if you bought on this day, a few months later, it was trading as high as like $25. So from 15 to 25, that's like a 66% gain or something. So is it right for a bounce? Well, look at the daily chart. You know, it looks like maybe it's not finished yet, but it's probably pretty close to finishing the selling. And so at some point, there's probably going to be a big snapback rally, maybe at least to 50 period exponential moving average, like something like $60 or something like that. By the way, none of these are recommendations to buy anything. I'm just thinking out loud of what I might do or might not do. Discovery monthly chart, similar to Viacom, it's up a lot. Now it's down a lot. And you see the weekly chart stopped right here. Daily chart, back down a lot. And it's going to turn at some point. Just a matter of how much lower does it go before it turns, who knows. So that's what you have to consider if you want to buy some. As for the large Chinese tech stocks like BIDU, they were having a really good run from 90 to like 350. So this was kind of a hiccup for them. Like I said, it could go lower if a lot of people are doing this strategy. A lot of more people still have to liquidate. Who knows? But like I said, it's down from 350 to 208 right now. And on a daily chart, it's actually up on Friday. So this could already be starting its turn. So this is one of the stronger Chinese tech stocks for sure. It's a real company, all that stuff, low PE. Tencent is another huge Chinese tech stock, PE ratio of only 33. It's up a lot on the year from something like 50 to 100, and now it's come down. Not that much, a little bit, $20 off the high or something. Weekly chart, not terrible, and daily chart is already bouncing from Friday. So this one is relatively pretty strong, I would say. It's only fallen 20%. So guys, that's a look at what's going on with Archegos and these margin calls and these block trades and what possibly is going to happen in Monday's market with Morgan Stanley still having more stock to sell in Viacom and possibly other stocks. If you like this video, hit the thumbs up and I'll see you on the next one, guys. Thanks for watching.